Hello, everyone, and welcome to Red Alert Diaries Live with Tanya E. Hood. And you see, I have a special guest joining me because we had a few technical issues in the beginning. We still want to make certain that we come on live so that you can see it. Because what if I told you that in just 30 days, you could completely transform your financial future without working harder? Just working smarter and having Mr. L.R. Cohen help you in the process. L.R., welcome back. Thank you for this morning's episode.
Thank you. Thank you for having me back. It's great to be here.
Glad you're here. Now, for those of you that did not listen to this morning's episode, well, I'm going to let him take a few moments and introduce himself. L.R., what would you like to share with the audience today?
I just want to say peace and blessings to everybody. My name is L.R. Cohen. I'm the founder of Lone Ranger Consulting. I'm here just trying to pay it forward, just trying to get that financial literacy out to the masses and doing it at a cheaper price, if you will.
We need to work on the cheaper prices. And speaking about
Yeah.
prices, let's have a conversation about prices because for some, the election was amazing. For others, it wasn't. But for all of us, prices are going to start changing. Can you give us some insight about what's going to happen with the pricing?
Yeah, it's a great question. So right now, just going into the end of the year or the fourth quarter rather, prices are trending back upward. The Feds, leading up all the way until September of this year, they were basically announcing price reductions or rate reductions, and just trying to get a rein on this inflation era that we're in. And in September, they followed through on their promise. They dropped the rates to as low as 4.99%. The company that I'm currently working with was offering around five and a quarter, still pretty competitive. But I'd say it was very short lived. It was only about 5 days, not even a full 7 days, and then next thing you know,
It was a joke.
um, rates went right back up. So it was short lived. So people are wondering, what's going to happen at between now and whenever the new administration is sworn in. And all I can say is right now is take advantage of the rates where they are because we don't know. The pricing for rates right now have changed as well. It's going to cost you more to get that lower rate versus your credit score. A lot of people think that right now, if you have a 720 or 750 FICO score, you can get the low rate. In some cases, depending on the product, yes, but overall, someone with a 750 and someone with a 550 can get the same rate. It's all about
Mm.
pricing now. How
Let's
much is it going to
pause
cost
there.
to get that low rate?
Let's talk about that because that makes you wonder, well, what is the purpose for some individuals to try to make sure that they get their score high? Because I know when I was walking through my journey, that low score meant high interest rate. You weren't going to get the low elements. And it wasn't until I got my score up. But if what you just said is true, a 750 score and let's say a 550 score, why? Tell us a little bit more about why those won't make much of a difference.
So in the mortgage industry, it's calculated on a heavier grading scale. So your credit score is still going to matter when it comes to your interest rate in the future. But right now, because business is so slow, the lenders who are still delegating the overall rules of approving these loans, they're becoming a little bit more lenient. But they also got to
Mm.
make money, so they're like, "Look, let's just go ahead and charge a universal fee for this same rate, and as long as you meet this threshold, we'll give you a loan. But if you're above it, I mean, that's fine, but you've already met it, so it's kind of like overkill if you're at 750." I've given loans to people with 550, same rate as someone with a 750. But I would also say right now, if you're looking to do home equity lines of credit or even apply for credit cards or personal loans, your credit score is still going to matter because those debts are considered unsecured debt. There's no collateral tied to it, like a car or a home or anything like that. So those rates typically are going to be higher than your typical rates that have collateral tied to it. So you can get an 8% or a 6% for a house or a car, but a credit card is going to be about 20 or 30%. But if you have a 750, you might get something in the 12s, or in teens, something like that, which makes a big difference in, interest payments over time.
And we don't often pay attention to those elements. So thank you for giving the insight about that because I know there's some people that are thinking, I'm working all this time trying to make sure that my credit score is where it needs to be and it doesn't make a difference. It's still makes a difference. And that leads me to this conversation because one of those things about getting credit qualifications, let's break that down because it's confusing for some when they know that they keep hearing you need a great credit score in order for you to get low rates. You need a great credit score in order for you to be able to have your buying power last. Let's talk about that credit qualification.
So, you have to understand how your credit score is, scored. So it's a few things. The two biggest things are your payment history and also the amount of debt that you finance. Those two things equate to about 60% of your credit score. 10% are inquiries. Now, I know people are scared to have their credit pulled because they're afraid it's going to drop their scores and things like that. But in actuality, it's how many credit inquiries do you have from different credit types? And what I mean by that is, let's just say you go try to get a home equity line of credit, then go get an auto loan or apply for a credit card. Those are three different types of lending. You have a mortgage, an equity mortgage, you have an auto loan, and you have an unsecured credit card. Those are three different types. If you apply for those three things all in the same day, that's going to kill your credit score. But if you haven't had your credit score pulled in months or even years, and you want to do a refi for an example, and we have to pull your credit, that's not going to kill your score. It's only 10% in when it comes to your to your rating. But if you miss a payment, that's going to hurt your score more than an inquiry will. So your credit qualifications, depending on what type of debt you or credit that you're applying for, you have to meet a certain threshold. So for in the mortgage industry now, you need a minimum of a 550 FICO. But if no mortgage rates within the last 12 months, you have a shot at getting a loan. But if you have like a 750 and you have a mortgage late, which is possible, it might be a slip up, here and there or something, like maybe you forgot to pay it, but that one mortgage late can get you out of qualification even with a good score. So, your payment history is pertinent when it comes to your credit qualifications.
And I like to share a little bit more because with those five factors, there are five factors that people typically have to look at. You talked about already having your paying on time. That is the bulk of it. Then the inquiry parts, the debt ratio is another piece. That's 30% as well. So when people are looking at these various things and they're like, okay, if I manage this and move this around, can you go into the five factors a little bit more? Because when I was supporting people going through the journey, because it was something I had to do, you don't have to watch your credit score every single day.
Right.
It fluctuates daily anyway.
Right.
Give yourself a set thing. What do I need to truly focus on? Because if you have a lot of, let's say no, just one card, let's make it simple. One credit card, and I use a simple number, $1,000 limit. But your $1,000 limit is got $900 balance on it. You need to make certain that you get that below
Yeah.
30% to give you a way of getting your score boosted a little bit higher. So that just may be your focus for the next month.
Yeah, in actuality, lending is becoming more lenient because with the prices going up, the applications for lending has gone down at least 46% these past couple of years. So
Mhm.
lenders are becoming more lenient. So now to your point, that credit utilization, now they want to see you below 50%. So they're kind of, adjusting the knobs here, if you will.
That's
So
good to know.
yeah, so if you have $1,000 credit card balance, getting it to 500 and below is going to help you a lot more. And to your point, that debt to income ratio, the guidelines for the feds, like a conventional loan or VA loan or an FHA loan, they want to see it around that 40 to 45% range. No more than 40 to 45% of your income needs to go towards your debts. But again, people need money. One out of three people are check to check. 6 out of 10 people aren't comfortable with their savings. So they're becoming more lenient now. So I literally just had a loan approved for 65% DTI. And as long as the loan makes sense now to the underwriters, we'll get it done because like I said in our last talk, the financial industry is the backbone of the country, and if the mortgage housing market goes down, then we could be in a lot of trouble.
That's what happened to us previously in this country where we had to have the bailout because of all the various things. And so that we don't go back down that slippery slope, give some people a little bit of idea about the current market and what they have to start truly paying attention to because the tides usually turn during an election year.
Yep, they sure do. So we'll definitely see what the next quarter brings. But what I would tell people is like, don't get that analysis paralysis where you're overthinking things and you sit on your feet and you end up missing the boat. Great example, like I just said, in September, the rates dropped from 7.5 all the way down to 5.25. People said they still wanted to wait after the election, and now they're minimum 6.25 to 6.5% on average now. So almost, a full point and a half, in just the span of a couple of months. So if you're looking to purchase or if you're looking to refi, I think the biggest thing you need to focus on now is how much can I save? Don't worry about the interest rate because
Mhm.
we're in a high priced market. It is what it is. But, if we follow the trends of the market, we always know that what goes up must come down and what is down must go up. So if the rates are up right now in time, history shows that, they'll eventually go back down. And there's a lot of programs out there, such as the mortgage company that I work for, that can help leverage that in the future.
Let's ask some questions about habits because in order for people to save the money, they're going to need to adjust some of their habits.
Hmm.
Tell us some of the common mistakes that people make that stop them from succeeding and getting this accomplished by saving the basics that they need.
Well, I think one of the biggest things is that people try to repeat the same process and expect different results. I mean, that's the definition of
Mhm.
insanity. So they have to not only just change their way of thinking, but they have to map out a plan that they have to actually follow and even possibly have accountability partners to help them with, just like a coach, a training coach at the weight room. That's what we do here at Lone Ranger Consulting. We help people through those first couple of weeks or even up to a month, just for them to get used to those new habits. And then once they get used to those new habits, we take off the training wheels, if you will, and then we become an accountability partner when we reach out to them each month to see how they're doing and if they have any questions or if they veered off or if we maybe need to tweak some things. Maybe, we put them on a budget that was good for a certain amount of cash flow, and then unfortunately something happened and now their budget is thrown off and we got to recalibrate. So, um, developing those new habits takes time. After 2 weeks, that habit should be formed if what they say is right. So, those first 2 weeks to a month, like I said, we kind of grandfather you into a new way of thinking, a new way of managing your finances, and then you take the leash off and say, go play.
So I have this whole different concept about the forming habit. They do say 21 days to make a habit, but I don't believe that. It takes you 21 days to figure out that you need to make the change. You try to put forth the effort, but then you fail so many times.
Yeah,
I think if you stick to something for 100 days, 100 days gives you clarity of being mundane because a habit is mundane.
yeah.
But celebrate the small wins. Take yourself out on a thought process if we're going to use it 21 days, basically 3 weeks. Week one, what small change did you make? Did you accomplish the same small change the following week? Did you do
Hmm.
it again the third week? By
Hmm.
then, you sort of got a groove. But
Hmm.
celebrate that small win. What other advice would you give somebody that they can use practically to secure that? Okay, I think I can do this. Create an emergency fund, set aside the small cushion, put aside the down payment. What can you share with them as a tip or two to get them there?
So I would say, from starting small, try to go a full week without buying any lunch or Starbucks or anything like brown bag it the entire week. Just try it out, meal prep, do whatever it is that you got to do. Make a big pot of spaghetti like my mom used to do and just have it last the whole week. It's cheap and easy. You'll save money that way. And then the money that you save, right? Just leave it in your checking account. Try not to use your debit card at all, unless it's an emergency. If you gotta get gas or something, completely understand. But like, try not to do any like small purchases for lunch or anything like that. Start there, and that will kind of give you that mind over the flesh matter where you can control your body. The mind, if you train the mind, the body will follow. And then eventually you'll see that, okay, I went 3 days without buying something. I went 4 days without buying something, or I've changed my cheat day, or as far as buying lunch or something for Friday. I'll leave it for Friday, and I'll be disciplined Monday through through Thursday. Little things like that. And as far as like savings goes, I think the easiest way would kind of be like that auto debit, that out of sight, out of mind. Like create a savings account with no ATM card, nothing, just a regular savings account that you have to go in and withdraw from, from like a credit union that's far away. So if you so if you got to
As
get it, you got to.
inconvenient as possible.
Right, exactly. We don't need no credit union around the corner. Something that's gonna take you some time. You got to get up and go through a few lights, right? And have an auto debit on your check. Just have like 5, 10, $15, whatever you can spare, or whatever we budget out for you if you do one of our consultations. And just have that put into that savings account and don't check it to the end of the month. And next thing you know, you'll forget all about it. And 3, 4, 5 months later, you'll see like, oh wow, yeah, I got some money in the bank. But you've developed that discipline to not touch it. You got to let it grow.
That part. Because if it's too convenient, we're gonna make some excuse or some
Some
reason.
excuse, something.
For those of you that listened to this morning's episode, he gave us another tip. It's called the cash system, knowing where every dollar goes, but using cash in hand. For those that did not get the chance to listen, and if you didn't listen to this morning's episode, go back and listen to that as soon as we're done here today. Tell them a little bit more about the cash system to give them something more tangible that they can start working through to boost their confidence.
So, when you're dealing with digital currency, it's very easy to like lose track of it. But I've come to realize that if you have cash in hand, you become you're better with the management of it because you actually see it physically going out of your hands. And the cash system is simple. Use it for your day-to-day expenses rather than using your debit card. So, for example, if you know you spend $50 a week in gas, that means you have a $200 monthly budget in gas. So with your first paycheck, you take out $100 in cash, you put it into a little envelope and just label it gas. You know you spend $100 a week in food, that's $400 a month. When you get your paycheck, if you get paid bi-weekly, take out $200 in cash, put it in an envelope and just put food, so on and so forth. And then when you go to the grocery store, take that envelope with you, and that will keep you from using your debit card and you know having multiple pending transactions. I know we've all known about that. We look at our account, it says it has $1 amount, and you're doing in your head, you're like, oh yeah, I spent this, that, and the third, and then the next day everything posts and you're way off. You may even be overdrawn depending on what you spent.
Mm, that part.
So that helps prevent that. And then also it teaches you to save your money in your checking account, for discretionary income. For example, you never know, like what if your tire goes out and you need an extra $200? Well, now you got that discretionary income in your checking account rather than dipping in your savings. Or if you were able to save $1,000 in emergency cash, now you can dip into that versus putting it on a credit card or asking somebody for some money.
And for those of you that are hearing this, it may sound a little similar to the envelope system. Yes, it's the same way. Find the best way that supports you in tracking your money so that you know what I often share with my children because I had to help them. And here's another thing, help your children figure out how to budget with you
Please, please.
because that is where a lot of
They're
our
our
money
future.
ends up going away. And I told my children every dollar needs a job.
Mm,
So you
mm,
don't tell your money where to go. It's going to decide on its own to just run away, and it runs away quick. Let's
yep.
talk quickly about that. Helping people keep their money grounded by doing this one thing nobody wants to hear because some of them think it's a curse word, but it's good for you. Budget. Talk about a simple budget.
Like a budget, all it really is just mapping out where your money goes and just making sure that you're not overspending on things you don't have to overspend. But the issue is the discipline. Unfortunately, if your parents aren't financially illiterate, odds are you're not going to be either. So understanding that a budget is not a bad thing. Every company has a budget. Everybody's job, if they didn't, if their back end didn't follow their budget, we wouldn't have jobs, right? So it's not a bad word to try to evade. It's something that you need to embrace because it's going to teach you the discipline that you need. And I think that's one of the problems that the credit boom of the 80s created on the new generation is instant gratification. We want it now. We want to buy that new car now, or we want to get those clothes now, so we use the credit card for instant gratification rather than doing a regular budget and putting money away for it. So
Let's talk about that because now that you bring up all these different questions in my head. We don't often pay attention to the financial literacy that we need to have. And for those individuals that ended up with their credit journey, like I did mine, on a college campus getting your free t shirt, all you had to do is sign for the little card
I
so
fell
you
for
can get
that
your free
too.
t shirt.
Mine was a sandwich. I was hungry. So,
See, they know how to get a college campus. And you did not pay attention to it because you did not have financial literacy to get you through the process.
yeah.
Talk a little bit more about some basic financial literacy elements so that those individuals that may have found themselves in similar positions, students starting out, people that started down that road but never got enough training, but you are in the hustle and the bustle trying to get out of that financial hole that you
hmm
found yourself in. Let's talk a little bit about that.
So if you find yourself in debt, or if you see, if you feel like you're lost, with where to go with just how to map out a financial plan, the first thing I would start with is pulling your credit report and seeing where you are. You can go to annualcreditreport.com. You can sign up with, Credit Karma to get a credit score, credit report, or what have you. And what I would do is, whether they're collections or whether you have, active debts, take those debts and order them from the smallest amount to the largest amount.
Mm.
And then from there, what you want to do is you want to try to either increase the minimum payment for the smallest one, or any extra money that you get, throw it towards that smallest balance. Once that's paid off, you want to do what's called a debt snowball, where you take that same money that you were just using to pay that debt, you roll it into the next account, and you just repeat the process. And if you have more than, two, three, four, five accounts, you'll see that you're increasing the minimum payments, but you're not spending any extra money. You're just simply reallocating the money that you're already using, but just in a different way. So you do that, you pay the debts off a lot faster, or you'll decrease the utilization, which increases your credit score, which helps you with lower financing in the future. And then from there, again, if you stay consistent with, just simple savings, just put a little bit away each week or each month or what have you. And as you pay those debts off, increase your savings, increase your paying off debt, use that 50-30-20 rule that we always tell our clients to use, and you should be good to go.
Okay, this is a lot more amazing information. If you did not listen to this morning's episode, go back because, in addition to the great information that you just received in this moment, he shared a whole lot more. LR, thank you. Thank you so much for sharing what you've given to our audience. And I want you all to pay attention to the Lone Ranger. Tell them where they can reach you and how they can get greater insight to get you to support them on the journey.
Yeah. So if you want to get more of the content from my podcast, you can like and subscribe on YouTube, at the Lone Ranger Podcast. It's the Lone Ranger '08 on Instagram and YouTube. Like and follow there as well. And for consultations, you can email me at loanrangerconsulting at yahoo.com. And I'll be able to go over your free consultation and then discuss a budget plan for you.
Well, thank you. So you all see the information at the bottom. Make certain that you reach out. And I'll go back and ensure that I place that information down in the comments below. And as you are listening and looking and getting great insight, reach out to him and let him know how supportive this is. Even if you don't find yourself in a current position where you aren't sure that this is for you, if anything that we have shared with you today resonates with you, like, comment, and then share it with others. Let them know where they can get some support along the journey. Ella, is there anything that you would like to leave the audience with before we start wrapping up?
Trust the process. That's all you have to do, is just trust the process. Give it time, and eventually it'll manifest if you faint not.
Well, I don't think there's anything else that I need to say. We thank you so much for joining us on Red Alert Diaries Live with Tanya E. Hood and our featured guest, Ella Cohen. We look forward to seeing you next time. Take care, everyone. In the
Thanks,
meantime,
Tony. Have a good one.
this this is Tanya E. Hood, walking in my purpose and with you to do the same. Take care, everybody.